Right, let's welcome our first guest, Nirav Sheth of Edelweiss Financial Services now joins us on the show. Nirav, hi, good morning. Good to have you back
Hi.
after so many years. Uh,
Thanks.
what's the call on the market? It's been a big bull run that we have seen over the last 6 to 8 months. Do you think this can continue?
Yeah, I mean, I think there is little doubt that, you've seen the worst in terms of the economic outlook, and probably you've seen the worst of inflation outlook as well. I think the key question that we need to ask is that, do you have now a political mechanism in place which can take the structural growth rates of the economy higher, let's say to about 8 or 9%, 2, 3 years down the line? And at the same point of time, can you take the inflation down? I think that is exactly what is happening. I think we'll be surprised in terms of the required rate of returns for investing in the markets coming down and the markets getting re-rated. So at least that is a thought process that we are having, and we'll eventually have to look at how the policies are planning out and whether our hypothesis matches with what is happening on the ground.
Nirav, hi. Thanks very much for joining in. What would your strategy be towards a couple of these sectors which are cyclical in nature but are now seeing some amount of profit booking in today's trading session particularly? For example, metals and maybe even oil and gas. Would you still be bullish on it, or possibly on a structural point of view for a 3 months to 6 months horizon?
On a structural basis, we would not be bullish on the global cyclicals very clearly, and simply because of the fact that there is only so much of NPV that you can essentially create by adding more expansion-led earnings, right? And we are not very clear in terms of how the global commodity prices are going to behave. We are actually bearish on that, and the stocks have run up significantly in expectations of earning upgrades. If you ask me if there are two sectors that I would be willing to bet on, it will be consumer discretionary, largely autos and banks. Those would be our preferred bets for the next 6 months, 1 year, and within banks we would like private sector banks, some of the public sector banks, NBFCs, the entire lot. You will see some serious upgrades in earnings as we go forward.
Okay, so Nirav, in terms of stocks like Larsen and Toubro, ONGC, SBI, the kind of leaders we've seen for this market, at current valuations, do you think these stocks can eke out more outperformance, or would you now look to some of the defensives for the second half of the year?
Well, I still believe that it's too early to get into defensives. First of all, so if you remove software and you come to consumers, the valuations are still not very cheap. I would tend to believe that the stock will still have to correct maybe a 10-15% for investor to get excited, or else they'll time correct, in which case anyway they'll become cheaper as you move forward a couple of quarters. In software, we are tactically bearish. When I say tactically bearish is that that there is some amount of risk to the earnings for FY15 numbers. But when you look at FY16 and FY17, we believe that there is enough momentum in that sector, and the valuations are very cheap. So at some point of time, we want to upgrade the sector, but we still believe it's early days. There's something else you asked me apart from defensives.
Yeah, about the stocks like ONGC, Larsen, SBI, would you stay invested in some of these names?
SBI very clearly yes. Larsen has been one of our top picks. It has done very well, but I would tend to believe that we'll have to appreciate the fact that capital goods is essentially a late cycle play. Again, the hypothesis that you built is that unless and until the inflation doesn't come down, you are unlikely to see any significant investment spends on the government happening, which eventually means that my economic recovery will be delayed, probably getting into FY16. To that extent, I think valuations are slightly ahead of the story as far as Larsen is concerned. With the caveat that, we generally like the story, it is just that, it's too fast too soon, and eventually we'll see some sort of time correction going there. Oil marketing companies, I think a lot of things have got discounted simply because of your expecting policy reforms to happen, which in all probability will likely happen as well. Outside that, I think now we'll have to look at earnings. I think the re-rating process is over. You have to look at earnings, and I think that will take time to play out. And, a lot of the subsidies are still in kerosene and LPG, and it's not very clear whether, what sort of reforms will happen over there. I'll take my bets off the oil and gas sector right now.
Okay. Nirav, I just wanted to ask you a more broader question, the same point that Anuj and me were discussing right at the start, that maybe there are certain sector of a clutch of stocks which have now been shifted to the T2T segment, and that indicates that maybe the regulator is getting a little worried about the frothiness that is taking place in the market. Would you share that view as well?
Well, there will always be some pockets of speculation happening in some selected stocks. But let me give you this data, right? I think the Indian institutions have lost about $16 billion in the last 2 years. I'm talking about the mutual funds, and I'm talking about the insurance companies. And we've been perpetually underinvested in equities for the last 6 or 7 years. Now, we are talking about a significant sum of money coming back. Now, you cannot change the human nature. For the first time, you've got a situation where equities are doing well, real estate is not doing well, and gold is not doing well. Therefore, money has to come back. And obviously, what you're essentially seeing is that stocks are up 30-40%, but they've been down 90%. So I cannot paint all the stocks with the same brush. So in some cases, obviously, there will be some speculative activity. It's good that regulator is taking a very proactive approach. But having said that, I think there are too many ideas around. Usually in these kind of markets, you tend to run short of money, not of ideas.
So give us some ideas then, Nirav, at your end.
Well, I won't get into specific stock names, but I'm saying let's look at it. For example, insurance can be potentially very big sector 5 years out. General insurance can be a very big sector 5 years out. There'll be a lot of shifts that have been happening in some of the sectors as you move from unorganized sector to organized sectors. So like I said, we're not talking about, few mid-caps which are undervalued. I'm talking about structurally large sectors that can evolve over the next couple of years. Insurance, general insurance, it could be organized retail as well. You're seeing those kind of things happening in bearing sector. So I'm saying is that first of all you have to look at normalized earnings, because everything that you look at right now, when the earnings are around 80%, you tend to get very nervous because the P's are 20-25. Look at normalized earnings, look at normalized ROE, and then take a 2-3 year call. I'm sure that there are enough ideas, there is enough money to be made in some sectors.
Would banks be one of them?
Sorry?
Would banks be one of them?
Yeah, of course, banks. Banks, I think it's, just look at it. When you look at banks, first of all, almost everyone makes an ROE. So I would tend to love those sectors where, a guy with a 10% market share and a guy with a 1% market share makes an ROE. So there are some cyclical movements in ROE, but there is no structural impairment. De facto. So, you'll have a lot of NBFCs, very strong underwriting skills in very selected niches. You'll have a lot of, new banks, private sector banks. And you've got new institutions becoming banks, and therefore, at some point of time in next 2-3 years, there'll be some M&A activities happening over there. So a lot of changes on the anvil. Yeah, but bullish on banks.
Okay, Nirav, we leave it at that. Thank you very much for joining.